All right, let's talk. If you're self-employed, a freelancer, a business owner, you already know the struggle. Your income is just not the same month to month. So how in the world do you get a home loan when it feels like traditional banks just don't speak your language? Well, today we are breaking down a really cool solution built for the way we actually work now.
Let me just ask you that directly. For a huge part of the workforce today, the answer is a big fat no. If you're out there grinding in the gig economy, running your own small business, your income has peaks and valleys. It's got a rhythm. But the problem is, traditional mortgages, they're built for a steady, predictable 9-to-5 paycheck. And that leaves a lot of really successful people kind of stuck on the outside looking in.
And look, we are not talking about some tiny, niche group of people here. According to the Bureau of Labor Statistics, we're talking about over 17 million Americans who are primarily self-employed this year in 2024. This isn't some fringe movement. It is a massive and growing part of our entire economy.
And this right here, this really gets to the heart of the whole problem. On one side, you've got the classic W-2 employee. Their pay stub is clean, predictable, lenders get it, it's easy. But on the other side, that's the entrepreneur's reality. You've got fluctuating cash flow, money coming in from all different clients, and, of course, legitimate business expenses. It's like they're trying to communicate in two completely different financial languages.
This is what I like to call the outdated money maze. So let's dive in and really break down exactly why the standard old-school mortgage process so often just completely fails this huge chunk of the population.
Okay, here's the fundamental conflict. Any smart business owner works with their accountant to legally and smartly minimize their taxable income, right? But all those valid write-offs for equipment, supplies, marketing, they create what we call an adjusted income gap. So the number a bank sees on that final tax return, it's often just a tiny fraction of the real cash that's actually flowing through the business. And let's be real, this income is never simple. A freelance designer might be a sole proprietor. A landscaper, they could be an S-corp, paying themselves a salary plus dividends. That Amazon seller might be a C-corp. Every single one of these structures makes the income look different on paper. And that's before you even start talking about all the side hustle money coming in through Stripe, PayPal, or Zelle. A one-size-fits-all approach, it just doesn't stand a chance.
So it all comes down to this one critical number, your debt-to-income ratio, or DTI. The lenders, they're looking at that lower after-deductions income number from your tax return. So when they stack that up against your debts, your DTI can look terrifyingly high. You could have tons of cash in the bank, but on paper, the official math just doesn't work for them.
But what if there was a different way, a better way to look at income? That's where this more flexible path comes in, and it's called a non-QM loan.
Now, I know the names sound super technical, right? Non-qualified mortgage. But the idea is actually incredibly simple. A non-QM loan is just a loan that doesn't have to follow those super rigid, one-size-fits-all government rules. Instead, it uses alternative and frankly more common sense methods to prove that you can actually afford the loan.
This is the game changer. It's a fundamental shift in thinking. Instead of obsessing over the bottom line number on a tax return, non-QM lenders look at the top line. They look at the actual cash flow, the real revenue, the deposits hitting your bank account month in and month out. So, how does this work in the real world? Let's pull back the curtain and go beyond the tax returns to see how these loans actually get the green light.
I love this quote because it just hits the nail on the head. There's this myth that self-employed borrowers are super risky, but the reality is their financial story is just told through different documents. In fact, think about it. Most business owners protect their personal credit like their life depends on it, because, well, often their business does.
And you don't have to take my word for it. The data is pretty mind-blowing. Recent studies show the default rate on these bank statement loans is just 0.21%. To put that in perspective, that is less than half the rate of so-called prime jumbo loans. The huge loans given to people with the absolute best credit. These borrowers aren't risky, they are incredibly reliable.
So how do they do it? It's surprisingly logical. An underwriter will take 12 or maybe 24 months of your bank statements. They add up all the business deposits, apply a standard expense factor based on your industry, like say 50% for a service business, and boom, the result is a qualifying income that actually reflects your real-world spending power.
And this approach is an absolute lifesaver for any business that has seasonal income. Think about a roofer who's crazy busy in the spring, but things slow down in the winter.
By averaging their income over a full year or two, the lender gets a much more accurate picture of their real earning power. It just smooths out all those natural peaks and valleys.
Okay, so who actually qualifies for one of these things? Let's take a look at a few of the programs out there because they're definitely not one size fits all. They're tailored for very different financial situations.
First up, let's talk about borrowers with good credit, a FICO score of 660 or higher. This is perfect for the person who has their finances in order. They just don't fit into that perfect little box for a standard agency loan from Fannie Mae or Freddie Mac. And these loans can go all the way up to $3.5 million.
Then there's a program for folks with a FICO of 620 and up. This is often designed for people who are actively on that credit repair journey. The rules are a bit more lenient, like you only need to be 36 months out from a bankruptcy, and the loan amounts can still go up to $2 million.
And for those who've had some more significant credit challenges, there are even options with FICO scores down to 550. This can help people who've had a really recent bankruptcy or foreclosure, sometimes as recent as just 1 day prior. It's a system that gets that a past event doesn't have to dictate your entire future. And these loans aren't just for the self-employed. They are a fantastic tool for tax-paying residents who aren't U.S. citizens yet, and also for people buying non-traditional properties, things like mixed-use buildings, hobby farms, or multi-unit homes that traditional lenders tend to run away from.
So let's zoom out and look at the big picture for a second. This whole shift is about way more than just one type of loan. It's really about a whole new way of thinking about lending itself.
The number one takeaway here is that the old-school 9-to-5 economy is fading into the background. And our financial tools, well, they're finally starting to catch up. They're adapting to the flexible, dynamic, entrepreneurial way that millions of us actually work and build our lives today.
And what's really happening is that lenders are realizing this modern borrower is an awesome client to have. These folks are often way more financially savvy. They see their home equity as a strategic tool for growth, and because they're always networking with other entrepreneurs, they can be an amazing source of referrals. They are not a risk. They are a massive opportunity.
So this leaves us with one final thought to chew on. We've seen how home loans are adapting, but as your own career gets more flexible and less traditional, what's the one financial tool you wish would change to better fit the way you actually work and live? Something to think about. Thanks so much for tuning in.